The fastest way to blow up your trading account is that if you decide that you don't want to learn anything about risk management. So, in this video, I want to help you understand the basics of risk management. Beginners don't understand this formula that you see in front of your screen. The portfolio size multiplied by your position size multiplied by your risk, which is the stop loss, that is equal to your overall portfolio risk. That is the amount of risk that you're taking on a particular trade. If you understand this formula, you have understood risk management. The formula is very simple, but the formula gives you four different kinds of risk management systems, which I want to explain or discuss in this video. Okay, so let's begin. Let me enlarge this for you. So don't blow up your trading account. Very easily, you could end up losing all of your money if you do not understand position size management and risk management. So please pay attention to whatever I am discussing here. Okay. Yeah. So what is position size? Let's say position size is 5%. So position size is basically this is the amount of money that I will put into a stock which I have identified as a proper setup. This is a stock that I want to buy. So let's say my account is 100,000, whatever currency you want to use, dollar, euro, rupees, whatever. So 5% of 100,000 is 5,000. So let's say Indian rupees. So I will put 5,000 rupees in a particular stock in which I am interested in. That is called as the position size. What is risk? Risk is basically the stop loss. So if I buy here, I will keep a stop loss of 4%. 4%. So 96% of my buy price. So my buy price, if it is 100, then at 96, I will keep my stop loss. Okay. So that's my 4% risk. So if I buy 5,000 rupees worth of stock, and if I lose 4% on that stock, if the stock goes down after I buy, how much will I lose? I will lose 4% of 5,000, right? Which is 200 rupees. What is 200 as a percentage of 100,000? It is 0.2%. So this is called as portfolio risk. Let me set up the pointer here. Where is my pointer? Yeah. So this is your portfolio risk. So position size is 5%, stop loss is 4%, and this is your portfolio risk. Now, if I increase this, if I decrease this, and if I increase this, this would remain the same, correct? So look at this. I have decreased it from 5% to 2.5%, and I have increased the risk by 100%. Okay, so 4% has become 8%, and here 5% has become 2.5%. So basically, what I'm trying to say here is you can play around with the position size and you can play around with the stop loss level, provided that your overall risk, your overall portfolio risk, the amount of money that you are putting at stake on a particular trade, you have predefined that amount. Mentally, you know how much money you are going to lose in that stock. So if you increase your position size, but you want to reduce your overall risk, then you will have to shrink your stop loss. And if you reduce your position size, you have that flexibility to keep a wider stop loss. Okay. So this equation, position size multiplied by your risk is equal to portfolio risk. This gives rise to four different kinds of risk management systems, which I want to discuss in this video. So let's have a look at those systems. Okay. And this is very important. This is the basics of risk management. So please take notes. This is the most important risk management video that you will ever watch on the subject of stock trading. Okay. So please pay attention. So this is how it looks. Let me. Okay. Yeah. So position size, let's say this is the first system, position size constant. stop loss is constant, portfolio risk constant. So let's say position size is 2.5%, stop loss is 8%. This portfolio risk is going to be 0.2%. So what I mean by this is, let's say you have 5 stocks in your watch list for the next day. Okay, you want to buy these 5 stocks the next day if they trigger your buy point. Now, in that case, you will put to 2.5, you will put 2.5% of your portfolio in each of these 5 stocks, and on each of those 5 stocks, you will keep a 8% stop loss. Okay. So your position size on all the 5 stocks is constant. Your stop loss on all the 5 stocks is constant. So the amount of money that you're putting at stake, the amount of risk that you're taking is constant on all 5 stocks that you have in your watch list. So let's take the example of this stock. So let's say Zomato. Okay. Let me help you understand this. So I will not discuss why I bought the stock at the yellow line. I have made, I think, a couple of videos on this stock. But let us look at the buy price. This the yellow line is my buy price. That's where I bought the stock. So I will put 2.5% of my portfolio at the yellow line if the stock triggers the yellow line. Now, position size is up to you. You can take 5% position size, 10%, 20%, 25%. Okay. The bigger the position size you take, the larger is the risk that you're taking. You should be aware of that. Okay. The more money that you put into a stock, the more money you are likely to lose. That is common sense, right? If the position goes against you. Okay. Now, let's say as per the first system, as per this system, okay, I am putting 2.5% here, which is 231.20, and my stop loss is at 8%. So what is 8% of 231.20 stop loss? So 0.92 multiplied by 231.20. So this is 2.12 to 212.70. So 212.70. That's my stop loss. You see this red line? This is my buy price and this is my stop loss. So this is, I will do this on every stock, all those 5 stocks on my watch list. So the amount of money that I am putting at risk is constant on all 5 stocks, irrespective of their price. Okay. One stock could have a price of 231, another stock could have a price of 4,000. But if both the stocks hit their stop loss, the amount of money that I will lose is same in both the cases. Okay. That's the whole idea here. So you are not taking different risk on different stocks. So that's your first system. Now, what's the advantage of the system and what is the disadvantage of the system? See, every decision that you take, there is always an advantage and there is a disadvantage to that risk management system. There is no risk management system which is, foolproof. There is no risk management system which is failure proof. Every decision that you make has got repercussions. So let me explain here. What's the advantage of this? Look at this setup and tell me what's the advantage of this. I have a 2.5% position size. I have an 8% stop loss. So the advantage is obvious here. You are giving the stock enough room to fluctuate. Okay, your stop loss is not too tight. That's the advantage. What's the disadvantage here? The disadvantage here is your worst case scenario is too large. So if you have 5 stocks on your watch list, assuming all 5 stocks get triggered, now suddenly your total worst case scenario is 40%, because on each stock you have an 8% stop loss. 8% multiplied by 5 stocks equal to 40% risk on a position size, of course, on 2.5%, which is 40% of 2.5%. You could potentially lose more than 1% overall of your portfolio if you do that. Okay. And losing 1% of your portfolio is a large amount. Okay. So the advantage is you are keeping a wider stop loss. You are giving the stock enough room to fluctuate. The disadvantage is your worst case scenario is very large. Okay. And that is not a great idea. Let us look at the next system. The next system is where your position size is constant. So let's say you keep 2.5% position size here. Now, some people do 5% position size, some people do 10%, some people do 20, 25%. Depends on the market, depends on the personality of the trader. I am more of a conservative trader. I like to start with small position size, book some gains, and then gradually increase my position size. Okay. That is my style of trading. Now, your stop loss is variable. So, obviously, constant multiplied by variable is obviously going to be variable. Now, this is a tricky situation. Here, you are not taking the same amount of risk on all the five stocks that are there in your watch list. So, what's the advantage and disadvantage of this system? So, let's say you have five stocks in your watch list. On the first stock, you keep a stop loss of 8%. On the second stock, you keep a stop loss of 4%, just random. On the third stock, you keep a stop loss of 2%. On the fourth one, you keep a stop loss of 1%. Whatever you want to do, okay? 1%, 3%, 2.5%. You decide based on whatever technical factor that you see on the chart, you decide what stop loss you want to keep, okay? So that means you're not taking the same amount of risk on every stock in that watch list. Your position size is the same across all the five stocks. What could possibly be the advantage of this system? Let us go back here. So let's say you look at this base. So this is 0.1. This is 0.1 in the base, the highest point. This is 0.2. This is 0.3. And this is 0.4. So the low of this candle is 0.4. So let's say I decide that I want to keep 0.4 as my stop loss. Now let's keep the stop loss at the low of this candle, which is 226.05. So I go to here, 226.05. So now this is my stop loss, okay, as per the second system. Let's measure what is that stop loss. So my stop loss here is 2.28% roughly. What was the stop loss earlier? It was 8%. Now it is 2.28%. Is it better? Fantastic. It is better. I have reduced my stop loss by, I have cut down my stop loss or cut down my risk by 75%, right? When you go from 8% to 2%, you're cutting down your risk by 75%. That's the advantage of this system. You are limiting your losses. Okay. Imagine in the first system, in this system, okay, in this system, what was your worst case scenario? 40%. In this system, what is your worst case scenario? It is less than 40% because you are not keeping 8% stop loss on every stock in your watch list. 8% is the maximum that you are putting. Okay. But there are some stocks where you are keeping 2% stop loss, just like I showed you on the Zomato chart. So that reduces the average, that reduces the average risk that you're taking per stock, that reduces the worst case scenario. Okay. That's the advantage. What's the disadvantage? Well, look at the chart. Let's say the stock hits this, triggers your order. Now you have 2.5% of your money invested in the stock. What if it comes down, hits that red line, and then doubles from there? That's an opportunity loss for you. So the market will hit your stop loss, kick you out of the trade, and then the stock will double from there. It will go from 220 to almost 500. That's a pain. Okay, that will give you that will make you experience a lot of emotional pain. So the disadvantage of this system is you are not giving enough room for the stock to fluctuate. So although your risk on the stock is reduced by 75%, but another risk that you have added to the stock is the shakeout risk. Okay. So as I said before, every decision you take in terms of risk management has got repercussions. It has advantages and disadvantages. It has pros and cons. And you as a professional trader, you must understand these pros and cons. Okay. Beginners don't understand these pros and cons, so they disregard the concept of risk management and position sizing, and then they end up blowing up their account in almost 6 months or 1 year, whenever they start. And then they wake up to the fact that, okay, there is something called as risk management, which I need to learn. Okay. So please pay attention to what I am discussing here. The same stock, the same base, the same setup. However, the way I am approaching the stock in terms of position size, placement of stop loss is very different. And I know whenever I take a decision, what's the advantage and disadvantage of that decision. Every coin has got two sides. Okay. Let's go to the third system. This one. So your position size is variable. So let's say you have 5 stocks in your watch list. On one stock, you keep a position size of 2.5%. On another stock, you keep 5%. On another stock, you keep 10%. So your position size is not the same on all the stocks in your watch list, but your risk is constant. Like the stop loss is 8% across all. So here, your portfolio risk is obviously going to be variable. The amount of money that you risk per trade is obviously going to be different for different stocks, correct? The problem with this approach is your portfolio risk is directly proportional now to your position size. So the more your position size, the more is going to be your portfolio risk because you kept the stop loss constant. Okay. So don't do this. Do not use this system. This is very dangerous. Now, why is this dangerous? Now, imagine there is stock A and there is stock B. Here you keep 5% position size. Here you keep 10% position size. After you buy both of these stocks, this stock goes up 4%. This stock goes down 4%. Okay. Now tell me, are you making money or are you losing money? Obviously, you are losing money because the stock where you put double the money as stock A is going down, and the stock where you put less money is going up. So basically, you ended up putting more money in a stock that is going down compared to the stock that is going up, right? So that's a loss. Okay, don't do that. Okay, don't use this system. This is very dangerous. Okay, this is a system that you will not use because you're directly the portfolio is becoming directly proportional to your position size. That's a very risky proposition. So don't do that. See, this one you're trying to limit risk. This one you're trying to keep the portfolio risk constant. So these two systems are acceptable. Okay. But this one not acceptable. Number 4, this is a fabulous system. Okay. What you are doing here is you are keeping the position size and stop loss variable, but the portfolio risk is constant. Look here. Here, your position size is 5%, risk is 4%, portfolio risk is 0.2. Now, if I reduce the position size and I increase the risk stop loss, my risk total risk remains the same. So I can now this system gives me a lot of flexibility. I can play around with my position size and risk to arrive at the same amount of money that I stake on every single trade. Okay, so let's look at this system on this example. Now, let's say I keep a position size of 2.5%, and now let's say I want to keep the distance. See, from here to here, the distance is roughly 2.28%, right? So in this equation, this one becomes 2.28%. Okay. And here I have 0.2%. So almost, see, I have reduced from 8%, I have gone down almost to 1/4. So if I am reducing my risk by 1/4, obviously I should increase my position size by 4 times, right? So obviously my position size should become 10%. 10% of 2.28 is roughly 0.2%, 0.228%, right? So naturally what is happening here is that the tighter, see, the tighter is the distance between the yellow line and the red line, the bigger will be your position size, because the amount of money that you're risking is constant. And the wider the distance between the yellow line and the red line, the smaller will be your position size, because if you increase the stop loss, you will have to reduce your position size. So naturally, what is happening with this system is that this kind of system is forcing you to take a large position if you have a tight base, and a small position if you don't have a tight base, which is exactly what we want, right? As breakout traders, as professional traders, that is exactly what we want. If a setup is becoming tighter and tighter, it is becoming even better. And the best setups deserve the best position size without increasing overall risk. That is exactly what we get with that fourth system. Now, you understood all four systems. The question is when to use what. Now, this is the difference between a normal professional trader and a champion professional trader. Okay, you should know when to use which system. So basically, if you see Mark Minervini, who is a US investing champion, two-time US investing champion, he starts with somewhere here, and then gradually he moves to this system. I have not seen him use this system. So he would start with this one or this one, but gradually as the market starts to do well, he moves to this system. So he progressively increases exposure in stocks without increasing too much of risk, or he's using money from his earlier trades to finance future risk. Okay, so the difference between a normal professional trader and a champion professional trader is a champion knows which system to use when. I will tell you which system is ideal to be used when. When the market is very forgiving, when the market is good, and if the breakouts are working, like if you take five, if you have five stocks on your watch list and you see three or four of them moving up, okay, that's a good market. In that market, you should be using this system. This system number four. This system should never be used. And when the market is choppy, when the market is bumpy, when the market is very volatile, you should be using these two systems. Because here your overall risk is limited. Here your overall worst case scenario is something which you can control with your position size. Okay. So these two systems are very good for proper risk management in a choppy market. This system is very good for pushing the accelerator in a very good market. Okay, because this system will will force you to put a large position size when the base is becoming tighter and tighter. And the tighter the base becomes, the better is the setup, and the better the setup, the more money you're likely to make. So these are the four risk management systems I want you to start thinking about. I would say start with this, gradually move to this, and then gradually move to this system. Don't use the third one. So if you have any doubts, comments, or you want to discuss this, please let me know. I personally use these systems because I am naturally a conservative trader. So I use both of these systems. Sometimes I might also get in here. I will use my realized gains to finance bigger position size that I am taking. So I generally try to avoid the fourth one unless the market is really good, which it was in November, December 2023. That was the time I started using this system. That was the time I was using this system. But after January, February of 2024, I came back to this because I saw that the markets are becoming more bumpy and choppy. Okay, maybe because the market is overextended. But anyways, I hope this risk management video has helped you. Take this table, think about it. Take this formula, think about it. You can play around with risk management systems, but any plan is better than no plan at all. So please have a risk management plan before you start trading. Okay. Thank you so much.